Building a Forex trading strategy. Step-by-step process. A well-defined trading strategy is essential for success in Forex trading. It provides a systematic approach to decision-making, helps manage risk, and increases the probability of profitable trades. Building a Forex trading strategy involves several key steps that beginners should follow. Let's explore the step-by-step process. Set trading goals. Start by defining your trading goals and objectives. Consider factors such as desired returns, risk tolerance, time commitment, and trading style. Clear goals will guide your strategy development process and help you stay focused. Choose a trading style. Determine your preferred trading style based on your personality, available time, and risk tolerance. Common trading styles include day trading, swing trading, and position trading. Each style requires different strategies and time commitments. Select currency pairs. Identify the currency pairs you want to trade. Focus on major currency pairs with high liquidity and trading volumes. Research and understand the unique characteristics, volatility, and correlations of each currency pair. Perform market analysis. Conduct thorough market analysis to identify potential trading opportunities. This includes both fundamental analysis and technical analysis. Fundamental analysis involves assessing economic indicators, news events, and central bank policies that can impact currency prices. Technical analysis involves analyzing charts, patterns, and indicators to identify trends and support and resistance levels. Develop entry and exit rules. Define clear entry and exit rules for your trades. Determine the criteria for entering a trade, including specific technical indicators or chart patterns. Establish rules for setting stop-loss orders to limit potential losses, and take profit orders to secure profits. Implement risk management. Incorporate risk management techniques into your trading strategy. Set risk limits for each trade based on your risk tolerance and account size. Use position sizing techniques to determine the appropriate trade size based on the risk-reward ratio. Backtest and demo trade. Backtest your trading strategy using historical data to evaluate its performance and profitability. Use trading platforms or specialized software to simulate trades based on your strategy's rules. Demo trade in real-time market conditions to further test and refine your strategy. Monitor and adjust. Continuously monitor and evaluate the performance of your trading strategy. Keep a trading journal to record your trades, including the rationale behind each trade and the outcome. Analyze the results regularly and make adjustments if necessary to improve the strategy's effectiveness. Stay disciplined. Stick to your trading strategy and remain disciplined in your trading approach. Avoid impulsive decisions based on emotions or short-term market fluctuations. Adhere to your predefined rules for entering and exiting trades. Continuous learning and improvement. Forex markets are dynamic, and it's important to stay updated with market trends, economic news, and evolving trading techniques. Continuously educate yourself through books, courses, webinars, and interaction with other traders. Adapt your strategy as needed to align with changing market conditions. Conclusion. Building a Forex trading strategy is a systematic process that involves setting goals, selecting a trading style, conducting market analysis, defining entry and exit rules, implementing risk management, and continuous monitoring and improvement. A well-designed strategy based on thorough research, testing, and discipline can provide a solid foundation for successful trading in the Forex market. Remember to align your strategy with your personal trading goals, risk tolerance, and trading style.